Hi, welcome to Akshaya Money Management. This is Narasimha Kumar for the April series. We have started the new financial year. Let us see how this year will going to look like. Today, the most worrying factor is inflation. So today topic, let us see how the inflation impact the stock market. Before going to this topic, let us see what happened in the month of March. March, as everybody knows it, because of the war, we have seen the Sensex going down as low as 52,500, and from there, market started picking up, and today it is 60,000. We have seen it, and the reason for this one is one of the positive is FIS. Last time, if you remember, in my video, I told if market should pick up from here, the only support you require from the FIS. And that's what we have seen in this month. Let us see. No doubt in the March 2020, 43,000 crores FIS have removed the money. No doubt from the last May 2021 onwards, they're net sellers. But for the last 10 to 15 days, from the March 16th onwards, we have seen the small pockets of the money FIs are coming into the Indian markets. So we started with 300 crores in the March to 16th. From, if you see the highest is March 31st, they invested almost 3,000 crores in a single day. So this is a what market we have seen the V-shaped recovery because of the FIs are started investing into the market. So no doubt our DAs are investing, but market was not able to take it to the high levels. The support we got it from FIs, and we got into the 60,000 level as of today. So no doubt we have seen the ups and downs. So if you see in the last 6 months, we have been telling you should expect very minimal returns this year. So we are expecting this year will be a single digit return. So that's what we have seen the last 6 months, hardly a single digit returns we have seen in the stock market. So let us see what are the other positive things we have it. Other things is GST. The GST will show you how the Indian market, Indian business is doing. So today we have seen the all-time new record of 1.42 lakh crores collected in the month of March 2022. That shows that business are not impacted because of all these wars or all because of the COVID cases. So there's a second positive. At the same time, we have a negative, which is our topic is inflation increasing. So let us see the inflation the two ways. One is the consumption inflation. As of the latest one, the consumption is gone all-time high of the 10 months, which is right now is 6.07 is recorded in the February. As of today, it is 6.2% in the month of April 2022. So what it means for us? Let us take a company HUL, where it gives a wide spread of the products from the day you start. It may be brushing, or it may be taking your food, cleaning. All these things has been increased if you have noticed in the last 1 month. The products or food eatables, or it may be a tea, or it may be a washing dishes. Everything is increased. If you notice, 10% it is increased. Let me take you to the prices which is increased, the oil prices, LPGs, gas, medicines, electric goods, even automobiles. If you want to go to the film tickets also is increased. And if you want to go out for a trip, the toll prices also is increased. So it's going to affect from the April 2022. So why this is all increasing? No doubt we are seeing as a common man, which is affecting the pockets. Groundnuts and it may be cooking oil, we have seen 50% increase already from the compared to last year. Vegetables, or it may be dairy products, we have seen the 30 to 35% increase. It all happened because of a single thing is the petrol and diesel prices are increasing. If you see the crude prices compared to the last year, usually the last 5 years crude prices are in the range of $50 to $75 per barrel. Now it is trading in between 100 to 110. So we have seen significant 25% to 28% increase in the crude prices. Because of that one, all our consumption stories, we are seeing the prices are increasing. Not only the consumption, if you see the housing, there is a housing construction because India's major things depend upon the housing. So if you see the housing also is increased, because the demand is created, because last 2020, you see the inflation is less and interest rates also they decreased it, because from a 10%, 9% to is gone down to 6 and 6.5%. We have seen that there's a lot of demand is created for the housing as a sector. But what is happening right now? No doubt interest is less. No doubt there are the demand. People are coming and buying the houses. But is the prices will be going to remain same as last year? Just check it out. The steel prices last year, if you want to construct the house, 45,000 per ton it was there. Today it is already 75,000 to 80,000 per ton steel today rate is there. And if you want to cement, if you see the cement from 350, it gone to 440. So you're seeing almost like a 40% to 50% increase in the basic commodity to construct the house. So it may be consumption, or it may be housing, or you can take the other automobile sectors or any other sectors. If we take it, the base, the raw materials is gone up. This all prices increase not because of the demand is created, not you and me purchasing more cars or more houses, because as the raw materials increasing, the prices are increasing. So that is the most worrying factor as of today. Whether sales affordability will be same. That is a one first question mark. And second thing is, if companies observe all this cost, then first thing is companies will not going to make the profits. If the companies does not make the profits, then obviously their company stocks will not do well. If company stocks does not do well, then stock market will be in the question mark. So these are all the interchange, what we have a supply chain problem, what we are facing it. So we does not know today what we are seeing inflation, how big it is and how big it may affect in the coming months. So we should be careful. You and I, definitely we cannot change the inflation. So the best thing what you have in your hand is to how do you save better so that you can beat the inflation. So if your money is lying in the FD, or if you're thinking that FD is a better option to invest, just see this example. After that, you can take a call on that. For example, FD today, all national bank is giving around 5%. And after tax, the net you may get it in between 3.5 to 4%. And inflation eats away your 6.2%. That means your real rate of return is hardly minus 2.2%. Let me give you a small example. If you're investing 100 rupees in FD, no doubt after end of the year, after paying tax, 100 rupees will become 104 rupees. But your inflation, if you see what you can able to buy with the same 100 rupees, so minus 6.2, if you make it of 104 minus 6.2, you'll get hardly the 97.8 rupees. So think before whether you should continue in FD or you should put new money into it. So this is a time where you should make your money to work hard as you are working. For example, this is a time where the inflation is high, your growth stocks will not do very good, your value stocks will do very well. So what do you mean by value stock in simple terms? The value stocks has a strong cash flows and it is likely to go in a slow manner of growth, but they are fundamentally very, very strong. So for you, I made a list of the top 15 companies, 15 stocks where inflation, if it is more, these are the companies can do well. Some of the sectors I picked up from the IT or consumption, or it may be chemical, or it may be a media. So these are the 15 companies where you can look into to make your own portfolio. If you think that this is not my cup of tea, then you can look into some of the mutual funds where they have a value funds. You can invest into these mutual funds, which will do better than the inflation and which can beat the inflation for you. So there's a time where you should be smart. Last 2 years, we have seen it, very good growth, stocks doing well. This year, you may not see the run up like last year, 40% returns, 30% returns, that you cannot expect it. Keep a as low as to single digit return for this year. So this is our Akshaya research. A lot of customers have given the money to us, and this is about performance. From the last 3 months, market has given hardly 1%, whereas we had given 5% returns. And last 6 months, again, still 1% is the market is given. So we are given 9.5 percentage, and last 1 year when the market is given 18 percentage, we are delivered 31 percentage. So either you can make your own portfolio, or you can go to mutual funds, or we are the Akshaya Money Management. We have it where we can make your portfolio better and to beat the inflation. So hope this video was useful for you. So let us catch in the next month.